Hey everybody, Chris Englebert with Englebert Financial Advisers in Allentown, Pennsylvania on a beautiful fall day here in the Lehigh Valley. And guess what? It's the first of the month update for October 2023. What are we going to talk about today? We are going to talk about investors' frustration with the investment markets in both the stock and bond category. Now, hopefully you've been watching my monthly videos, my first of the month updates. If you want to go back, you can get on our website and we have all of these first of the month updates on our website. But in July, I was talking about the fact that the market, the S&P 500 had peaked and that we thought that there was going to be some type of 5 to 7% pullback. Well, guess what? We're right now in the midst of about an 8% pullback. The pullback started in July, went through August, accelerated in September, and here we are at the first of the week of October, and we're seeing the pullback now. But more importantly, we have a chart here, compliments of Eddie Effersbein on Twitter, who I follow, and he shows a chart that the S&P 500 has literally gone nowhere for the last 27 months. And so that's why I'm saying that there's a lot of investor frustration out there because we basically have been trading sideways for 2 years. So many investors want to see their accounts go up literally every day, every week, every month, every year. But that's not how investing works, people. The way investing works is you've got to stay in the game. And there'll be periods of time like now where we see consolidation. So last year, the S&P 500 was up about 17% for the year. Down about 17% for the year. At its peak in July, the S&P 500 was up about 17%. It's now up about 10%. But if you dissect a lot of the other indices out there, for example, if I would show you the equal weighted S&P 500, it is now down slightly for the year, along with the Dow Jones Industrial Average. So don't get spooked out of the investment markets, pun intended, because obviously it's October, but you've got to stay in the game. And what we're saying right now is that investors are frustrated because basically the equity markets have gone nowhere for a little bit over 2 years. Now, one thing that a lot of investors don't realize is that when they look at a mutual fund or an ETF or a separately managed account and they're comparing investment returns and they're like, hey, the 10-year annualized return on this fund is 10% a year. Well, that doesn't mean the fund does 10% every year. That's the annualized return over a 10-year period of time. There are periods of time where the equity markets go up 20%, and then like last year where they were down about 16, 17%. So you got to stay in the game in order to make money because returns in the investment markets don't come in a straight line. They come in chunks. So what's going on in the 10-year Treasury? We have seen interest rates float up. I actually should update this chart because they did hit a peak this week at 4.8%. And everybody's like, the 10-year Treasury is going to 5%. Well, we think, again, we've been saying ever since the end of August that interest rates and bond funds, and especially lengthening your duration and buying longer-term bond funds is the place to be right now. In the last couple of weeks, you were given a chance to buy longer-term bonds. So instead of just crowding in short-term bank CDs, which are still a very good alternative right now, take some of the interest that you earn from those short-term bank CDs and put it in longer-term bond funds. Because at some point, you could see interest rates come back down either 0.5% to 1% and see a good total return for 2024 in the bond market. We do think that short-term interest rates are going to stay higher for longer, but at these levels of a 5.4% on a 3-month CD, I could easily see bank CDs by next summer at 4% or even lower for short-term bank CDs. And that's why extending your duration or buying longer-term bonds tends to make sense, especially at this time. Now, I always like to tell my clients I'm looking for what is cheap out there versus what is expensive. And again, if you followed my first of the month updates, I talk about how this year the S&P 500 has been led by the FANG stocks again. Again, this is not a recommendation to buy or sell these FANG stocks, but Meta, Apple, Microsoft, Google, Amazon, Tesla, many of these companies have driven the S&P 500 as far as return goes, along with the NASDAQ. Now, the NASDAQ last year, the NASDAQ 100 was down 30%. This year, the NASDAQ 100 is up 30%. And again, it's a handful of these large cap stocks. This is a piece from Goldman Sachs. I can email it to you if you'd like to see the whole piece, but I pulled out a slide here for my deck that shows you that on a historical basis, small cap stocks have never been cheaper. So we are rotating, and we have been taking a large position over the last 18 months to 2 years in small mid-cap ETFs, small mid-cap mutual funds, and small mid-cap SMA or separately managed account managers as well. Because I believe that sometime in the next 12 to 24 months, you're going to see some money come out of these large tech companies and move over to the small mid-cap stocks because they're historically very undervalued. So let's sum it up. Equity indices continue their pullback into a seasonally weak September. October is known as the bear killer month. What do I mean by that? Bear markets mean the stock market's going down. Bull markets mean the stock market's going up. There have been more important bottoms made in the month of October than just about any month out there. Again, the 10-year Treasury has been the main reason why the stock market sold off in the month of September, and so far in the first week in October. We think that interest rates have probably peaked for the short term. I don't believe in the scenario that interest rates on the 10-year are going to 5, 5.5, 6%. I even heard a call for 13% on the 10-year Treasury. But again, we think you have to lengthen your duration, take some money and move it to longer term bonds to capture that coupon, because one of the things that will probably happen in 2024 is short-term interest rates will come down. Not a lot, but we expect them to come down. And again, if you're looking for what's cheap versus what's expensive in the investment markets out there, small mid-cap stocks are historically cheap. I haven't seen them at this level in literally almost 25 years, and we have been moving our clients into the small mid-cap area. So that's the first of the month update for October 2023. We'll be back in the first week in November, and we'll let you know what's happening and what our forecast is. And beginning in December, we'll give you a preview into what we think 2024 is going to look like. That's all for now. Thanks for watching.